What's up everybody, I am Jaspreet Singh, and there are two things that wealthy-minded people, you don't have to be wealthy to do this, but wealthy-minded people spend most of their time, effort, energy, and money trying to acquire, because when you buy these two things, it makes you wealthier. And the unfortunate part is that if you don't understand this, not only are you not going to be able to become richer, but you're slowly going to be becoming poorer, which is why it's so important that you understand this. In order for me to explain what these two things are, the first thing that you got to understand, and I'm going to very briefly go over this, is the difference between an asset and a liability. An asset is something you buy for the sole purpose of making money. It puts money in your pocket. And a liability is something that takes money away from your pocket. Now, the thing that you have to understand about an asset and a liability is that almost anything could be an asset or a liability depending on what side of the equation that you're on. For example, for the majority of people, when you go out and you buy Louis Vuitton, it is a liability. You go and buy a Louis Vuitton purse for $3,000, it's a liability for you because now you spent $3,000 of your own money, and if you don't have the $3,000, you gotta go to the bank with your credit card, and now you gotta finance this $3,000 purse, now you gotta pay it off with interest, and now this purse is gonna sit in your drawer and it's gonna be slowly losing value. You spent $3,000 on a purse, and now eventually this purse is gonna be worth nothing. However, for some people, Louis Vuitton is actually an asset. It's something that makes them money. And the reason why I know this is because the richest person in the world, he could be the first person, the second, sometimes the third, just depending on the day, but arguably the richest person in the world is Bernard Arnault, who is the CEO of Louis Vuitton. Now, he didn't get there because he was spending all of his money to buy Louis Vuitton, so he looks rich. He owns the company, he owns the asset, the Louis Vuitton brand, the company, and now when people go out and spend money on Louis Vuitton as a liability, you go out and buy the Louis Vuitton handbag, you are a consumer, you're buying just the product, but he is the one that's making money. This is why the two things that wealthy-minded people, you don't have to be wealthy to do this, but you have to be wealthy in your mind first. The two things that wealthy-minded people are working so hard to acquire, because this is something that will make you wealthier, are assets that pay you with cash flow, or assets that are giving you appreciating equity. And I guess it could be an asset that gives you both, because some assets will give you both of these, but this is what you need to be working for. I'm going to go over the different ways that you can get this cash flow and the different ways that you can get appreciating equity. But in order to do that, you have to understand how to actually use your money, because the way the finances actually work is a very simple formula. You take the income that you have, you subtract your expenses, and this equals your investments plus your savings. This is the basic formula to really building wealth. And once you understand this, you'll understand the different ways that you can buy these types of assets. So you take the income that you have from your job, your business, whatever it is, you take all the money that you're making and now you subtract your expenses. This is your home cost, this is your car, this is your food, these are your travel, your vacations, you remove all of your expenses, and then this is your leftover cash. And hopefully there is some leftover cash, because if there is no leftover cash, then you can't save and you can't invest. Now, traditionally, many of us are taught not to invest, or that investing is risky, and so what do? We save our money. However, your savings will never make you wealthy, right? This is not what wealthy people are looking to do. This is what wealthy people want to buy. Your savings are losing value to inflation every single day. So when you save all of your money, well, your savings aren't growing. This is why you need to put your money to work. This is where you need to invest your money. Now, where do you invest your money? You want to own these two things. And I'm going to talk about the different ways that you can get cash flow, different ways you can get this type of equity, but you need to be investing your money. So if you want more money to invest, either you can increase your income, or you can decrease your expenses, or you can do both at the same time. Because at the end of the day, most people talk about just decreasing your expenses, how you need to live smaller, live smaller, live smaller. But there's always a limit to how much smaller that you can live, right? I mean, there's a limited pie. If you're making 40 grand a year, there's a limit to how much you can cut. But there's no limit to how much you can grow. There's no limit to how much you can grow your income. So you want to be doing both, but you have to be able to have smaller expenses than income, no matter how much your income is. That way you have this margin so you can invest, so you can save. Now, you do want to save for emergencies, you want to save for investments, you want to save for big purchases, but if it's not for that reason, you don't want to just be saving your money just to save it. That way now you have more money to invest, and this is where now you have the cash flow and the appreciating equity. And the reason why this is so important to understand is because we're never taught about how to use our money the right way. We're taught to go to school, get a good job, get a good income, and then just figure it out. And what happens to so many people is we spend all of our money here and expenses to make us look rich, right? We buy the nice stuff, we buy the Louis Vuitton, we buy the Gucci, we buy the nice stuff which makes us look rich, but what's that actually doing? It's keeping us broke because we have no money for investments, we have no money for savings, but it's making the asset owners rich. It's making the owners of the Louis Vuitton company rich. This is where now you want to flip things around and not just be the person that's making everybody else around you rich. You want to make yourself rich first, and then you can spend your money however you want, because now that you can afford it, then go out and spend and buy whatever you want because you can afford it. But the key is you want to make yourself rich before you make everybody else rich. Now, obviously, part of this has to do with the system, because we live in a system where our expenses are always growing faster than incomes. However, we can't change that necessarily, but we can change our own selves, and we can take personal responsibility for ourselves, because at the end of the day, we do live in a consumerism culture where a lot of times people spend money not based off of what they can afford or based off of what they earned, but based off of what they feel like they deserve. I mean, this is just the society that we're in where, oh, I worked really hard, I deserve a nice vacation. I work hard, so I want to reward myself with a nice handbag because I deserve it, even though maybe you don't have the ability to afford it. Maybe you can't earn it, but you feel like you deserve it, so now you're willing to go into debt to go and buy something that you feel like you deserve, even though you can't necessarily afford it, or maybe you haven't earned it yet. I used to guest teach in Detroit public schools. It was a very rough area, and the interesting thing here is I would talk about leadership and financial education and just a whole bunch of life skills. And when I would talk to these kids, they were high schoolers, I would ask them, how many of you had a job? And almost everyone raised their hand. Then the next question was, how many of you have a bank account? Nobody, not a single person raised their hand saying they had a bank account. So what would happen? You would go work a job, make some money, take this check, go to a liquor store, get it cashed. The liquor store owner would take 1 to 10%, and now you would spend half of your check on pop, on candy, on a whole bunch of dumb stuff, and then you walk out with half of your check. And now when you have a few $100s in your hand, you feel like you need to spend it. It's this net zero thinking. I call it net zero, where when you have $500, you feel like you need to spend $500. Many times people think like this. We think, oh my God, if I had 10 grand, I would go on this beautiful vacation to Bora Bora. If I had 50 grand, I would buy this nice Benz. We think in terms of spending that if I had X number of dollars, I would be able to go out and buy this nice thing. However, that does not allow you to do this. Remember, if you want to build wealth, you have to have this margin so that way you can invest more money into these two things. And now let's talk about the different ways that you can invest for cash flow and with appreciating equity. Let me start by going over 3 ways that you can generate this type of cash flow. Number 1, I'm going to talk about is through real estate. The second way I'm going to talk about is through stocks. And the third way that I'm going to talk about is through a business. So let me start by talking about real estate, because this is one of my favorite ways to generate this type of cash flow. When most people think about investing in real estate, they think about buying a home for themselves. And when you buy a home for yourself, what you're doing is now you are going to put down some money to buy this home. You're going to get a mortgage, and now every month money leaves your pocket. You're paying for your mortgage, you're paying for your upgrades, you're paying for your property taxes, you're paying for your insurance, and your hope is maybe one day you'll be able to sell this home for a profit, or at the very least you're going to pay off this home. That way you have a paid off asset, but you don't get any cash flow through that. So when I talk about investing in real estate for cash flow, what I'm talking about is buying a property not for the purposes of you living in, but to rent out to somebody else. And so the way that this would work is, let's assume that you're going to buy this home, and you buy this home right here not to live in, and you buy it for $150,000. Now some of you might be thinking, where are you going to get a home like this for 150 grand? Well, look in the Midwest. I'm from Michigan, and so the numbers that I'm talking about are deals that you can still find today. So now you find this home for $150,000, and then you can turn around and rent this home to somebody for $1,500 a month. So now what does that mean? So you have this couple right here who want to live in your home. I'm gonna draw this guy a nice mustache, or as we like to call it in my native language, Punjabi, a much, and this lady who has a braid, or as we like to call it, a gut. They come and they live in your home. Now they get the value of having a nice place to live. They have a roof, they have a nice home, and in exchange, they're gonna pay you $1,500 a month every single month. Now, if you do this correctly, you take this $1,500 and then you're gonna pay off your property taxes, you're gonna pay off your insurance, you're gonna pay your maintenance costs, all the upgrades that come into the property, you're gonna pay for your management fees, because now I don't want you managing the property. I want you to hire a property manager. That way if something breaks, something goes wrong, it's not your issue. The property manager will deal with it. So then they pay for the property management fees, and then it will also cover your mortgage costs if you have one, if you don't have the 150 grand to go out and buy this property, and then it should put a little bit of money in your pocket. So now what are you doing? You pay for all these expenses, which let's just assume that the expenses in this case are $1,200 a month, including your mortgage, which leaves you with $300 a month of positive cash flow. Once you own the property, once you buy it, you've done the hard work. Now you own the asset. Now you hand it over to a property management company who's going to do all the day-to-day work. They're going to find you the tenant. They're going to deal with the tenant issues. They'll deal with the tenant complaints if there are any. And then they will make sure that you get paid every single month, and they'll also pay your bills. So all you have to do is every month you read a report that goes over what's going on with the property, what repairs there were, if there were any, and how much your profit was for that month. This is now a way for you to generate cash flow. Plus it can also give you that appreciating equity that I was talking about, because if now home prices go up and this home value goes up to $200,000, well, you don't actually make any money until you sell. Sure, you can refinance and pull some cash out. However, you don't actually get that money in your hand unless you sell. And then if you sell the home, then you also have that profit in the appreciating equity, because now you can sell your home for a profit. But when I invest in real estate, I'm not looking for that type of appreciation. That's not how I make my investment decisions. The way that I make my investment decisions is I look for one thing. I look for cash flow. My goal is to get a 7% cash on cash return on my money. What that means is that I'm going to buy this $150,000 property, and assuming that I buy this property all cash, no mortgage, I want a 7% return on my money. So if I put in 150 grand, I want to make sure that I'm getting $10,500 of profit every single year after paying all of my expenses. Remember, if I pay it all cash, I don't get a mortgage. If I get a mortgage and I put down 20%, which is $30,000, that means I invested $30,000 of my cash, and that means I want a 7% return on the $30,000 that I put in, which would be $2,100 of profit a year. So if I'm making $300 a month, that would exceed that $2,100 a year that I'm looking for, which is a 7% cash on cash return on my money. Now what am I doing? I'm investing based off of cash flow, and even if property values go down, well, I'm okay because I invest my money based off of cash flow. The second way you can do this is by investing your money in stocks, but more particularly stocks that pay a dividend. Now a dividend is when a company has a bunch of cash in their bank account at the end of the year, and if you're one of the owners, one of the shareholders of a company, they will give you your share of the profits. Now it's very easy to see which companies pay out a dividend. You can just go to any stock research website, any stock news website, enter in a stock, and if they say that they're paying a dividend, it will show you how much dividend they're paying. Now most companies pay a dividend every quarter, meaning every 3 months. And now the way that you can get this type of cash flow is by building up shares of this company. So I'll give you an example. At the time of me recording, this might change by the time you watch this, but companies like Verizon and AT&T are paying around a 5% annual dividend a year. Remember, in real estate, I was looking for a 7% cash on cash return on my money. Here, you're getting a 5% return. And the nice thing about this is you don't have to do any work. If you now go out and buy a share of Verizon or AT&T, they will pay you a 5% return on your money. So if you invest $100, you will get $5 in dividends. Now, of course, this isn't the only way that you can make money. You can also get the appreciating equity here as well, because if you invest in these companies and their stock price goes up, well, now your investment, your asset is more valuable, and hopefully they'll pay you more bigger dividends as well, because now the investment is more valuable. Now, of course, it comes with risk. There's also a chance that the stock price can go down, and there's also a chance that your dividends could get cut. So you want to make sure you understand this. That way you're doing the right research and the right analysis instead of just blindly throwing your money into a dividend paying company. You want to make sure you understand the company, understand the fundamentals, understand what they're doing, understand how they're investing in the future. That way you can make smarter decisions with your money. And if you do want some guidance on how to do this type of fundamental analysis and how to find good investments, you can check out Market Insiders. It's an investing education app that I created where every week you get access to stock market, real estate, and cryptocurrency coaching. So if you want to check out Market Insiders, I'll give you a free 10-day trial to do that and go through the entire thing, and I'll put the link for you down in the description below. Now, sticking with this example, there are 2 ways that you can go out and start building this type of cash flow. You can take a lot of your money today and go out and buy the stock today, or you can do something called dollar cost averaging, where you're buying in phases. Now, The strategy is going to depend on you, your lifestyle, your interests, and how deeply you want to check your investments and be involved with all of that. Because when you do this type of active investing, where you just make a big investment today, you have to really be aware of the markets, you have to be aware of the economy, and you have to be aware of your company, because you want to make sure that you're getting a good entry point, meaning a good price point to buy. And if you don't know how to do that, then maybe it's better for you to just buy in phases. Like, one of the things that you can do is just set up an automatic buy from any brokerage, or a lot of brokerages out there, which now you can just set up, I want to buy the stock every week. And now what you're doing is you're slowly accumulating more shares, more equity in this company. And over time, you're going to continue to build up these shares, which will keep paying you in more dividends. So over the years, you'll have this portfolio that's paying you bigger and bigger and bigger dividends. And you just keep building this up over time, because now even if you just invest $100 a week or $100 a month, whatever you can start with, every single year, you're going to be getting bigger and bigger cash flow checks. Now, again, the nice thing about this is you just have to find the right company. You don't got to go and now find the property and manage the tenants and make sure you have a good property manager and have a good property contractor and all of that. You're really just letting the companies, Verizon and AT&T in this case, run the company, and you're just owning a piece of it and getting your share of the profits. The third way to generate this type of cash flow requires the most amount of work, and is through a business. Now, there's two ways to go about doing this business. Either you can buy a business, like maybe a franchise or an already existing business, or you can create your own business. Now, I'll just kind of start with a little bit of a disclaimer, because I believe that everybody in America should own a business. However, the majority of people should not be in the business of starting a company, and the majority of people should not be in the business of operating a company, because it takes a lot of work, and you have to have that particular type of mindset of being able to do whatever it takes to grow and build a business. If that's not something that you're interested in, then stick with stocks, stick with this investing in companies instead of actually operating companies, because in this model, either you have to have a lot of capital to go out and buy a business, or you have to be willing to operate a company. So I'll talk about operating and growing a company, because that's the one that I have the most experience with. I do invest in companies, but I invest in companies for appreciating equity, not for this type of cash flow. So let me just explain how it works for me. So what you're watching right here is Minority Mindset. It's a YouTube video. This is really just my personal brand. However, I run a company called Market Briefs. This is a financial newsletter. It's a financial media company. I am the CEO and founder of Market Briefs, and I am the sole owner of Market Briefs. And so the way it works is, right now I am a worker. So I'm the CEO, worker of Market Briefs, but I'm also the owner of Market Briefs. So the way it works is I am investing my money into Market Briefs along with my time. So this is money as the owner, and this is my time as the CEO, in order to grow Market Briefs into a bigger financial media company. And my goal with this is to turn Market Briefs into a much bigger brand, which then will generate higher revenues and bigger profits. So when I work as a CEO, I pay myself a salary, although right now I'm not paying myself a salary. That way we have more money to invest in Market Briefs. However, the goal is one day that Market Briefs can become bigger, and then it can pay me a salary, and then there will be bigger profits in the company. Right now, our goal is not to have a profit, because our goal is to grow as quickly as possible. And if we have profits, that means we have cash sitting in the bank that isn't doing anything. I'd rather take this cash, invest it into Market Briefs, that way we can grow bigger, have a better product, and have better things that we can give to our readers, our briefers. So right now, we have no profits. But maybe one day, we will be able to have bigger profits in the company, and these profits go then to the owner. Now, right now, I am the only owner. Maybe that will change one day, I don't know. But right now, I'm the only owner of the company, and then what could potentially happen, just going along this example, it's just a hypothetical, is I get fired as the CEO. Maybe we find somebody else who could run Market Briefs better than I am, and now I get fired as the CEO. Somebody else comes in, and now they're a new CEO. I'll draw this person right here. They don't get a mustache, but this person is right here. They're the new CEO of Market Briefs. However, if nothing changes and I'm still the owner of the company, that means I'm still entitled to the profits, even though this person is now running the company, because they are better at me at running Market Briefs. Now, if that happens, guess what? I'm getting cash flow. I'm getting these profits without having to physically invest my time into the company. So when you're a worker, you're investing time. When you're the owner, you're investing money in order to get the profit in return. So there's two different ways that you can get paid, and if you can build a company that doesn't necessarily need you, well, then you can get your profits. And even if you're working in the company, you have to understand there's a difference in compensation for your time, and there's a difference in compensation for your ownership. For your time, you get a salary. For your ownership, you get the profits. The goal with all of these investments that I just showed you is to generate cash flow, meaning you put money in and now you're getting cash out without having to sell your asset. But the other way that you can make money is now you invest your money into this asset. That way this asset could be worth more money, and now once this asset is worth more money, so I'll give you an example. You invest $100 into this thing and now your investment is worth, let's just say $10,000. I know this is kind of an extreme, but now once it's worth $10,000, either you can sell this investment and now put the $10,000 in your pocket, or you can take a loan out against this investment, say $5,000, and now you don't have to sell the investment, but you have cash to spend. So this is appreciating equity, but now the question is, how do you get this type of appreciating equity? The first way is obviously real estate. I already talked about that, so I'm not going to go too deep into that, because if you buy a property for $100,000 or $1 million and it goes up in value, well, this is something that you can do. The second way that you can do this is, again, in the stock market. In the stock market, you have two types of companies. You have companies that pay dividends, and then you have companies that don't pay dividends. So we talked about what happens when a company pays a dividend earlier on in this video, where they have a big profit, they have a whole bunch of cash in their bank account, and then they can pay it out to you, the investor, the shareholder. And that might seem really great, but there are some downfalls with dividends, because if a company is paying a dividend, that means that they don't have a better use for this cash. So just think of it this way. So this company right here has, let's just say, $1 million in extra cash at the end of the year. This is their profit. Well, now they could take this $1 million and just pay the owners. So if there's a few owners of this company, they take out the $1 million, and now the owners have $1 million. This is a really weird face, I'm sorry. But now the $1 million are to the owners, and now they can go out, buy a nice car, buy a boat, buy a home, buy whatever they want, because now they have this $1 million in their pocket, which is why they're happy. However, if they took this $1 million and left it in the company, well, then this company could work to hire more people, more employees. They could use this company to invest in growth. They could invest it in advertising. They could invest it in a better product. So if the company took this $1 million and reinvested it back into the company, hopefully they'd be able to make maybe $1.5 million next year. But when you pull the cash out of the company can't grow as fast because there's less cash for them to reinvest back in the company. And so they have to have less money invested in advertising, less money invested in hiring more employees, less money in growth, less money in product development. So when a company makes that decision to pay out a dividend, they're looking at all their options and they're saying, well, we don't really have a better place to invest this money back in our company, probably because we're very large and we're very mature and we can't keep growing at the same rate as we were before. So we have a big profit now. And this is where it makes sense for us not to reinvest this cash back in the company. So we're just going to give it away to the shareholders. So that's what happens when you get a dividend. But when a company isn't paying a dividend, what they're probably trying to do, again, this is just a generalization, is now they're saying, we don't want to have big profits yet because we want to take all of this profit and reinvest it back into the company. So now you as the shareholder, the way you make money isn't through this cash distribution. So you're not getting that Lambo. You're not getting that nice home yet. You're not getting that profit distribution. Your goal is to have a more valuable company. Now, what makes it a more valuable company? Well, you're going to have more employees making better products. You're going to have more users, meaning you're investing in more advertisements, and you're investing in more growth. So you have a bigger company, which is now more valuable. That way, in the future, you can have an even bigger profit. So that way, you're not taking out a $1 million profit distribution. You're taking out maybe a $10 million profit distribution. But in order to do that, you have to be willing to invest more of this money back into the company. Now, of course, this comes with more risk because, well, now you don't get paid unless your investment becomes more valuable. So now you're investing and hoping that one day in the future, your investment is going to be worth more. That way you can sell it for a profit. So this is where now when you're investing in a company on the stock market, you're going to be doing this type of research, and now you have to decide for yourself. Do you want to take the additional risk of investing into a smaller, maybe a startup type of company that's trying to grow quickly? Because now the upside is you're right, and this company is going to be worth a whole lot more money, and maybe they'll pay a dividend in the future. So now not only did you get to buy in at a lower price, but you're also getting a dividend in the future. But the downside is, well, the company doesn't work. Maybe it goes bankrupt. Maybe they're never able to turn a profit. So this is going to require more work on your side to find what type of risk tolerance you have. Do you already want the profits today, or do you want to invest in potential profits in the future? The next way that you can invest your money into this type of appreciating equity is to invest your money in startups. Now, the startup model works very similarly to this, except pretty much every startup is not going to have this type of profit. So when you're investing in these startups, most of them are not going to have any sort of profitability. They're just working to grow bigger, faster, but your investment is going to be less liquid, meaning you make an investment in a company and you can't actually sell your investment, or you're not actually going to make any money until your company gets acquired, meaning they get bought out by a bigger company, or they hopefully one day go public. Now, before, this type of startup investing used to be very difficult, because how do you find these companies? How do you vet the companies? How do you give them money? It's a very complex process. Unless you had a lot of money, it was going to be very expensive and very time consuming for you to do this. Now, there's a bunch of crowdfunding platforms on the internet. A few of them are WeFunder, Republic, and Start Engine. All three of them are good, and I do have to disclose that I am an investor in WeFunder itself. But on these three platforms, you can invest in other startup companies, because startup companies are posting their companies here and they're talking about how they're trying to raise money, and now you can sift through ideas. Now, the risk with startup investing, because you got to know the risk, is that the majority of startups will fail. Remember, they're just startups. I think it's like 9 out of 10 startups fail. And so you have to understand that going in, that most of your investments probably will go nowhere. You're never going to see that money again. But the goal is that maybe some of your investments will do really well, and that will make up for the losses. Because if you can hit one company that gets acquired or goes public at a much higher valuation than what you bought in at, well, now you got the appreciating equity, because you were able to take that risk and buy into a company while it's still small. Or of course, if you have the entrepreneurial mind that requires the more work, instead of investing in a company in the stock market or investing in somebody else's startup, you could do the same with your own startup. If you have your own product idea, you can take your profits, keep reinvesting it back into the company, and invest your own money back into the company. That way your company would be worth more money, but again, it requires the most work on your end. Now, the last thing that I want to say about this, I kind of hinted at this in the beginning of the video. I know this is kind of a longer video, but the wealth that you build starts with your mindset. Well, it starts with your mindset. You got to be wealthy here before you can be wealthy in your bank account. And it really doesn't matter how much money you start with, whether it's $1 million, $100,000, $1,000, or even just 10 bucks, right? There's apps on the internet which make investing so much more accessible now, and everybody has to start somewhere. But now it's all a matter, going back to the formula, of having more of the money that you can invest, and now taking as much money as possible and start investing it for cash flow or this type of appreciating equity, right? You have to be able to think bigger, because if you don't think that it's possible for you, it's not going to be possible. So you have to believe in yourself first. And once you do that, you're going to continue to learn. You'll find ways to increase your income. You'll find ways to invest even better. But it all starts with that basic mindset of believing you can do it. And you have to be willing to think bigger yourself, because until you start thinking bigger, you're not going to start doing bigger. If you enjoyed this video and you want to see the 5 biggest lies that we're told about money that keep so many people poor, I made a video covering that, and you can watch the video by clicking this button right over there. Thank you for watching, and as always, keep hustling. If you make $1 million as an investor, guess what? You get to keep more than $700,000, between $700,000 and $800